How is investor psychology affecting the price of Bitcoin, and how is the rash of volume going on in zero DTE options potentially affecting the price behavior of the S&P? We're going to talk about that today on Office Hours with Professor Mark Guthner. I waited for the bell. Can you believe it? Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner of Rutgers. Mark, how are you today?
I'm terrific. Got no complaints in life right now.
That's good.
Yep.
There was an article that came out over the weekend. It was published in Bloomberg, or maybe it was late last week. I read it at the time that it came out, and then I was reviewing it again over the weekend, just sort of giving it some thought and thinking about how to explain this. The article basically was talking about the fact that so much of today's options flow, options activity, is in zero DTEs. That is, options that expire at the end of the day. And the strategy that they were talking about specifically was iron condors. What is an iron condor? Actually, I should probably just pull up, perhaps we'll pull up options play here, and we'll show what an iron condor is. An iron condor, when it's typically deployed by self-directed traders, is when a trader sells an upside call spread and sells a downside put spread. It's a trade that is intended to collect premium. Because options decay most rapidly as expiration approaches, options that are expiring on a given day are going to be the fastest decaying options, at least as a function of their own value on the board. The flip side of that, of course, is that it is also when gamma is maximized. And so that's the second derivative with respect to price. And so the reason that options traders will sell a strangle is so they can take advantage of this accelerated decay that occurs. The reason that they buy a further out-of-the-money strangle to protect themselves is because of this gamma element. In other words, you're trying to take advantage of theta, and you're trying to mitigate the effects of gamma. So a trade in something like this would look a little bit. Let's do, I think I can just default to this. Short iron condor, there we go. This is what that trade would look like. But these are very, very short dated, right? So
Now, Mike, when you think people do these zero DTEs, do you think they're putting them on in the morning for them to expire at the end of the day, or do you think they're doing them the day before? How do people trade those?
Typically, I think a lot of day trader types will put these trades on in the morning and just wear them throughout the day. We do trade a decent amount of zero DTEs ourselves in a couple zero DTE strategies. And we actually split that up. So we were doing all of it day of. We now do a small portion of it in the overnight. So it'll be initiated essentially on the close of the preceding day. And then more of it is put on a given day. Again, this is for our zero DTE strategies, which don't necessarily just trade iron condors.
Right.
But an iron condor is apparently, at least according to the Bloomberg article, the strategy that is most common in self-directed investors right now.
Interesting.
So effectively, you end up with a position that looks a bit like this. Now, of course, they could choose different strikes, but the idea is that you make money if things don't move, and you lose money if they do, right? So you're short volatility effectively. But the interesting thing about this strategy is that if you are a dealer, you end up being on the other side of this. So you own the tighter strangle, and you are short the further out of the money one. And the difference between dealers and most self-directed investors is that dealers hedge their gamma. They hedge their deltas. What does that mean? Well, it means that if you are long gamma, you are getting shorter deltas as the market declines. which means you have stock to buy. And if you are long gamma, you are getting longer the market as the market rises, which means you have stock to sell.
Mm-hmm.
Now, the byproduct of this is that means that the dealer now, the retail community isn't typically hedging their gamma. So if they were, then the two forces would offset one another. But because they're not, some people just say, I'm going to sell an iron condor, and then they set, forget, wait to see what happens by the end of the day. Maybe they have mechanisms to stop themselves out intraday if things aren't looking good. But in general, they're not dynamically hedging. And there's reasons for this also. One of those reasons is that each individual trader may not have material delta to actually hedge per se. So, for example, if I sell, one SPX strangle and I trade even E-mini futures, which rather than like a big future or a combo to hedge my deltas, I would need to trade quite a few of those iron condors before the changes in my delta would be sufficient enough for me to hedge. Whereas the market makers are taking all of these trades on in the aggregate. So what does this mean? What are they doing? And what's the interaction? Well, this is a histogram of returns in the S&P. And we'll observe that the orange line here, so that's this bit, this is kind of what a normal distribution would suggest you would expect to see.
Yeah.
But the histogram are the actual daily returns, and what we see is that they don't behave quite the way a normal distribution would suggest. Now, this is a phenomenon we've talked about many times. Equity returns, index returns, tend to exhibit skew and or kurtosis. Kurtosis is basically how short and fat or tall and thin and fat-tailed or not a distribution is. This particular shape, where you have a lot more events taking place close to the mean and events that are far from the mean taking place with greater frequency than the distribution would suggest, that shape is leptokurtic. Mesokurtic would be if it was actually short, right? So if our distribution looked like this, shorter in the middle and fatter, in this area, that is a mesokurtic distribution. But in fact, what we see is that we have a leptokurtic one. Okay, so far so good. This is just at this point it seems only like a theoretical exercise. Like we're only just, it's a little bit of an intellectual chit-chat that doesn't mean anything. But actually, I think it does mean something. And here's what I think it means. And then I'd love to get your input on this. So we were talking about this right beforehand. So let's just say, for the sake of argument, that this is the iron condor that the street is long. So this is what the dealers own. So they are long the strikes with green arrows. And let's say, for the sake of argument, that they are short the strikes with red arrows. This is a new little toy that Jay, the producer, showed me. So now I can actually change the color because I had it in blue, which I made it blue completely by mistake. Had no idea why. So what does this mean? This means that they have to sell stock. So I'm going to put a minus. They have to sell stock if it gets, once they get short gamma, they're going to have to sell. And once they get short gamma to the upside, they have to buy. Whereas, for their long strikes, here they have to buy to hedge, and here they have to sell. Right? So they're long gamma where it's green, they're short gamma where it's red. So what does this mean? Well, what it means is that if the stock market goes down to this strike, the market making community will start buying stock. That stabilizes the market on modest declines. So it makes declines in this region less frequent. Right? Similarly, if the stock market rises and they're long gamma, they have stock to sell, it might help stabilize the market a bit and thus reduce the number of instances that you see in here.
Mm-hmm.
This is sort of a theoretical conversation, just consistent with the article that Bloomberg discussed. But if this is true, so if we agree that that's the case, well, then we also would have to agree that at some point their gamma flips. They get a gamma flip, they go from long to short, and suddenly where they were a buyer, now they have to turn a seller. So if you start selling, this doesn't compress volatility to the downside. Now volatility would actually accelerate. Same thing here. And so that would help explain this shape. I hope this is sort of makes some intuitive sense to people. It would help explain why you get really wild outside moves, because the stabilizing impact of the market, and the market making community is a stabilizing influence in general. Citadel does not just make markets and options, they make markets and all kinds of things. What do market makers do? They are the buyer when there are no other buyers. They are the seller when there are no other sellers. So they're a natural stabilizing influence. They are what we call liquidity providers. What we're saying is that the impact of their liquidity provision to the marketplace itself ebbs and flows. And at least in as much as zero DTEs have something to do with it, it could have this effect of making the distributions more leptokurtic. This is my theory. This is my intuition, and I wanted to hear your thoughts on it. And you, I think, had some charts. Maybe we can show those.
Yep.
Because I think you were saying that there are some other things that we should be thinking about. So what are those?
Yep. Well, let's go before you run away. I'd like to see, you've got this going back to November 2024. What happens if we go back a little further in time?
How far back would you like to go?
Let's go back to another 2 years. So
5 years?
Yeah, whatever. At least 2.
Sure. Let's go back to 2022. Much more normal.
Yeah. Now, when did the zero DTEs become popular?
They've been becoming increasingly popular, and there are more instruments that have them.
Yeah.
And we also have those products that have them every other day, for example. So, essentially, whenever they've listed a zero DTE product, it seems like they've been quite popular.
Yeah.
The other thing we've seen in the options markets generally is this sort of this concentration issue. This is, I feel like this is a self-fulfilling prophecy, but what am I talking about? The bulk of options activity, 80% of it, I think, is concentrated in the top 50 most active single stocks.
Yeah, that's right.
And on top of all of that, even within that, there is high concentration. Tesla and NVIDIA routinely trade more than 3 million contracts a day, and those are high-dollar stocks. If you took out the top 10, you're lopping off a huge portion. Now, one of the things we've seen is that in other stocks, the volume has fallen off. At the same time, we also see wider bid-ask spreads. And a bid-ask spread is kind of like the market's form of advertising. Hey, come trade with me. If you have a really wide bid-ask spread, that's a deterrent to investors, even if the real price for an option might be found well inside of what we call the lit market, the touch, the lit bid and ask. Now, one of the reasons for this is that when I first got into the business of options market making, we had maximum spread rules. So dependent on the amount of premium in an option, the bid-ask spread could not be more than a certain distance apart. So for a really small option, it might have been an eighth. Yes, I started in the business when we still made options prices in eighths. And then very shortly thereafter, we went to what we called teenies. A teeny was half of an eighth. It's 1/16. We called it a teeny. Well before things traded in nickels and pennies. Now, I've traded in much smaller increments because natural gas, by the way, trades down to tenths of a cent in terms of the granularity of options pricing. But my point is that in those days, it was, all of the options pretty much had the spreads were very similar from product to product. The competitiveness amongst the market making community within any given product had more to impact liquidity than it did price. So the lit, especially when at one point you could not actually post quotes in anything smaller than an eighth, which is 12.5 cents, right? So it the whole market would be that. So what would ebb and flow is actually the liquidity that was there. And very often to get it, and we could trade things in the middle of that spread. People could negotiate a price that was in the middle, but you would trade it on what were called splits. So, for example, if I was an eighth at a quarter and something was going to trade at something closer to, say, 15 cents, which is 2.5 cents higher, the amount of contracts would be adjusted so that some portion of them would trade at the low price and some portion of them would trade at the high price, such that the average would. So that's how you would sort of trade in the middle. So just having those lit markets, that bid-ask spread didn't mean that you couldn't trade at something in the middle. Now, the reason, though, that these bid-ask spreads are wide, part of the reason is quote traffic mitigation. This is a technical problem. As the number of options has proliferated, more strikes and more expirations, and we started to trade in pennies and nickels, what it meant was that you started pushing a lot more quote traffic. I mean, at a very high level, you can imagine that if the number of options multiplies by 10, if nothing else changes, then you are pushing 10 times as many quotes. And that is actually a technical problem. You have to overcome that. I can remember, for example, when the American Stock Exchange could only push 8,000 quotes a second across the whole exchange.
Yeah.
Right? So now, obviously, that seems quaint now, but the point is that one of the ways that the market-making community has dealt with this, the proliferation of strikes and the quote traffic, is by widening spreads, and that rule is no longer enforced. So that has helped concentrate flow into those names with the tighter spreads and more activity. So it's become a self-fulfilling issue. This is my own 2 cents. I mean, one of the companies I traded right when I first got into the business still trades today. Nobody ever talks about it, but it was Ingram Micro. So Ingram Micro competed with Tech Data. You may remember this company.
Name.
And yeah, sure. So that was one of the products that I traded in the early days. Certainly it was one of my bigger trades that I got started with in the late 90s. Was a big straddle in Ingram Micro. Anyway, what are your thoughts here? We can expand this a little bit more. Let's go back to 2020 because we had the pandemic. And oh no, that's actually not going to capture the pandemic. So 2022 is when it really took place.
Yeah.
So this now, okay, so let's go like here. I'm going to go back to, so 2022, I'm going to go like this. This is when it really took off. 0 DTEs. And what you can see, actually, what would be interesting? Let's go back a little bit more. Let's go back to prior to that period. So let's go from...
Why don't you go to 2018 to 2022? Something like that.
Yeah, 2018 to 12/31/21,
Yeah.
like that. That's going to include the pandemic.
Hey.
Right? So this has got the pandemic in it, this is because we had that huge downswing. So actually, I almost think that the pandemic is its own sort of kettle of fish, if you will.
Yeah.
Maybe it would be wiser for us to just take a look at the price behavior, well, let's say for the 5 years leading into the pandemic. The pandemic was in basically February of 2020. So I'm going to go we'll go back 5 years. How's that? See what that distribution looks like. So still had some leptokurtosis.
I expect it to be so. You know what causes that to happen? Outside of the options is a variable volatility. So I do this when I model, that I use something called a bivariant normal. And when you use that, you get this leptokurtic structure where there's a lot of stuff in the middle, and then a lot of stuff on the ends, because you're jumping in between low volatility environments. So you got all that stuff in the middle. And then you leap to a high volatility environment. Then you have your observations at the tails. I use that in my first book on pricing bonds using option pricing theory.
Yeah, I mean, this is one of the enhancements that you were making to the assumptions that Robert Merton had, right?
That's right. So And that actually made the models work. Without that, the models don't work because they underestimate the tail events. It's kind of funny.
Mm-hmm.
We get 100-year events in the stock market about every 20 years.
Yeah, I think it feels like it's a little more frequent
Maybe
than that.
15. Yeah. So that's
Yeah, because I mean, think about it. Think about just since you and I have known each other, but at least as long as I've been in the business, the events that I often talk about are the collapse of the Asian Tigers that happened since I've been in the business, the Russian default, the tech wreck, the GFC took place, the flash crash took place, the pandemic took place. The tariff tantrum in Q4 of 2018 took place, which was pretty profound, folks. That was more than 20% in just a very short period of time, although it rapidly. Volmageddon took place. That was Volmageddon was what, late Jan, early Feb of 2018 after epically low volatility in 2017. And then, of course, we had the big, we had 2022 more recently, which was the rate hike cycle. And sort of a period of very high inflation. I'm not going to call it hyperinflation, but very high inflation that took place a couple years ago.
Yep.
And had a profound impact. So, yeah, I don't know. I mean, it certainly, if you had a normal distribution, a lot of the events that have taken place should not have taken place more than once in our professional lives, and yet they've taken place many times. And some events should not have taken place at all. So perhaps the best example of that was that huge intraday spike that we saw when the sort of that tariff cloud was lifted, and the markets just absolutely ripped. That would not have taken place. You would not expect to ever see an event like that in your lifetime if returns were normally distributed and if volatility was a sort of a continuous process that you could slice and dice into different intervals of time.
Yeah.
And what I mean by that is, can I take 1 year's volatility process and describe what I expect over a quarter or a month or a week or a day or even an hour, right? You divide by the square root of time, and you should, if the process is, that's one of the things that they, the sort of the underlying assumption is that the process has predictable behavior that you can expand and contract the window you're looking at. But in fact, that does not turn out to be at all true, does it?
No. Let's move on and hit that first slide because it kind of speaks to this distribution stuff that you were just talking about. So there it is. It's in the middle. Now, does everybody see that? I just see that as a little teeny thing in my screen.
I see a chart with a channel.
Yeah. All right. Just want to make sure everybody can see that because on my screen, I just see a little itty bitty box and I see your distribution.
Oh, what you want to do is you want to pin that look at your little bitty box and you'll see three little dots and ellipsis, and you pin that, and then you're going to see what everybody else sees.
I want to make sure everybody's seeing the right thing here. So everybody's getting very nervous about stocks, and I thought this was a very interesting channel because stocks have barely come off their highs, and yet there seems to be a lot of hand-wringing on financial media like something terrible is about to happen. And maybe it is, but it's certainly, I think people are at this stage of the game maybe a little bit too concerned, a little too fearful because we're kind of in the middle of that trending range. But when you showed me that chart at the end of the day, or just now before we got started on the show, maybe that's the thing that pushes us down either to the lower trend channel.
What is the lower end of that trend channel? I can't quite make it out.
It's hard to say. It looks like at the beginning of 2026, it's about 550 on SPY. So
that's sharply lower.
That's sharply lower. So maybe that does it. All I'm saying is that it's been quite a while since we've had a sell-off of significance. We had a little one there at the, I guess, what is that, second quarter? And we bounce
Yeah, we had I don't, has this gotten a formal name, by the way? I call it the tariff tantrum, I call it the post-Liberation Day tariff tantrum. Yeah. But I'm sure there is an official term, and I don't know what it is.
Works.
I don't know what people are calling it. Okay, so we'll call it that until somebody corrects me.
The tariff tantrum. I think that's a perfectly good name. So my whole point is let's not get too worked up over this, at least not yet. That said, as we always talk about on the show, that yes, you're cruising down the highway and you might have one foot over the brake, but it's not time. But it's not time to hit the brakes yet. At least I don't think so. And so I just wanted to point on that. It just seemed like financial media was getting really too worked up. Now maybe it's because we had some 500-point Dow days, but 500. There was a time when 500 points on the Dow really meant something. But now that the Dow is at a lofty level, I don't think it means that much.
The financial media, and having been a participant in it myself, I can verify this is true, but it's nothing everybody doesn't know already, is much like conventional media.
Yep.
And that is that 70 and sunny doesn't sell. Right? People love to talk about things when it's 20 below zero, or there's a heat wave and it's 105, or if there's a hurricane. You got to have something to talk about, and if there isn't something to talk about, you have to talk about the fact that something could get bad. Yeah. So we don't have a hurricane right now, but we could. It's hurricane season.
That's right. I think that's the amazing part about Tom Lee, about his ability to be bullish all the time, and he finds something to be bullish about, and that kind of lets us roll into the next chart, because let's take a look at Bitcoin. And I think it's at an interesting spot, because he's been saying for the past, 2 or 3 months that, we could see Bitcoin at 150, 180 at year end. And so he's getting pressed really hard. Do you still see those numbers by year end and so on? And he's kind of sticking to it, and that's fine. Bitcoin's one of these things that it can rip just as fast as it can, crash. But what I thought was interesting is we're kind of from a technical perspective, at an interesting spot, because we're sitting right on that long-term trend line that goes back to about 2015. I don't have data that goes back further than that. And I'm not sure the data is really too meaningful.
This is a great chart, by the way. Carter Worth, I was told, I didn't see it, but I was told that Carter Worth actually showed this exact same chart on Risk. I actually don't remember. Risk Reversal Media. It was Dan Nathan, Guy Adami. Okay. Carter works with them, so he was on their podcast. Yeah. I know all of those guys, of course, and my understanding is he showed this exact chart. It's one that I have myself looked at. I mean, so some of the things that I have tended to look at were the 50-week moving average, because we had an uptrend, and I talked about it on this channel. I think you and I talked about it when it looked like it had definitively broken that a couple weeks ago. I thought, okay, well then, once you have a technical break, and I will say this all the time. I look at charts, I pay attention to them, I think they matter, but I'm not a technical analyst, so if I have a trend line and it violates that, then I look for another one to see what the next critical level will be, and so on. And so I thought this was very interesting, because this was the next one to look at, and we're bounding right along there right now.
Yeah. So if that line breaks, then I was suggesting with this chart that there's a decent chance that it would go down to 70. 70K. 2 months ago, I was thinking, Bitcoin could sell off, and if it did, it goes down to 95, and that's probably where it goes in my worst case scenario, was down 8 to 85,000. And now I get a chart like this, and I kind of looked at this morning and said, maybe the downside is 70, but if 70 goes, then it's like all hell breaks loose and it falls
Oh
down to
boy.
like 18 grand, and people are going to jump off buildings. Uh,
Mm.
and I don't think it's going down there, but as I like to tell my students, price can do whatever it wants. Um,
Yeah, indeed.
we've seen that happen. It depends. I just think I one of the things I do think is, there's a lot of leverage players that have been flushed out. I don't have a feeling for how many are left, or if they're all gone. If they're all gone, then we're more likely to go higher than lower.
I mean, I'm looking at this chart in real time on my screen right now. I don't know if we want to show this or not,
Yeah, why
but
not?
what I'm gonna do here is let me just get rid of these grid lines because I really want to make this as. So one of the things that I always find kind of interesting about technical analysis is that it's not immaterial to think about how thick you draw your lines.
Yeah.
Right? Because I made this line as thin as possible. If I made it thicker, I might obscure the fact that at least it looks to me like I can make this thing really fat, like this. And lo and behold, well, even if you make it fat, see, it does look like it may have violated that. Don't know. That's what it appears to have done. Right there, we can see it. You can see a little bit of white below that even very fat red line. You don't see it anywhere else in here.
Yeah, I'm looking up. I can't remember the authors of the book who made this seminal book on technical analysis. I'm having one of those days where I can't.
Moments.
Yeah, so those senior moments.
Yeah.
What is it? So I'm doing a quick look over here. But the point of the book was, and this was written years ago by Mackey, or does that name sound right?
Well, when I think Mackey, I think of Jeff. He was one of the OG fast money guys. He was on for a couple of years.
Yeah. Anyway,
but
the point was they were saying that John McGee. I think that maybe that's the guy, Edward McGee. Maybe that's the book. Trying to remember. That's in the 8th edition now, according to Amazon. They were talking about you think about a real violation that goes 2% beyond the line, that anything kind of around there is still, let's say,
still in play. It's not definitive.
Yeah, they're still respecting the line.
So that is consistent with something that I heard Carter Worth say many years ago. He said, one way to think about these things is not like a hard marble floor, but rather like the top of a mattress, right? So you can hit it, and you can actually sink into it a little bit, and then sort of rebound.
Yeah, I think that's right.
Now, I would add, and when it comes to broader market indices, this could also make some sense, because think about the vagaries that go into the construction and pricing of the index intraday. There's a lot of things moving around, so a lot of people could actually be looking at levels, but at any given moment, the actual construction of sort of the composite is going to end up having those little vagaries baked into it. So I've heard some people say it has to violate somewhat definitively, check back to it, and if it does not go back above, then that's kind of a sign that you're in real trouble.
Yeah.
Again, I am sharing what others who I respect have told me.
Mm-hmm.
I don't claim to be an expert on such things. We have a couple questions here, and some of them are certainly appropriate for you, I think. And one of them is a comment, which I think is interesting. I actually flashed this on the screen before. Seven Figure Mission said, buy in the morning. And actually, it does, what we've been talking about is consistent with some of the price behavior where it does make some sense to, to buy dips and sell rips.
Yeah.
Because you're essentially going to have real money. You're going to have market-making community doing something similar around you. So I go along with that. But this is something that seems particularly well-suited for you. Jim Howard says, I've often read that HYG, the high-yield corporate bond ETF, there are others, Jim, by the way, a good friend of mine, somebody that Mark is also acquainted with. He helped found HYLB, which is a competitor to HYG. Yep. He's one of the managers of the Texas Employee Retirement System pension, and they have a big high yield portfolio. As you would expect, these ETFs have huge utility because sometimes, obscure, off the run high yield bonds don't have massive amounts of liquidity. So when people are managing portfolios that include a couple billion of them, these ETFs are awesome because they create pools of liquidity. Mm-hmm. You can do in-kind exchanges, swap baskets of bonds for the ETFs, and then the fund manager now has something that trades a lot like a stock. If you're rolling over a portfolio, or if you have one portfolio manager taking over for another, this is a very powerful tool that they now have. And HYLB was created as a competitor to HYG because the pensions, of course, are very sensitive to the fees that they're paying.
You're right.
And that was in there. But the question that Jim asked, I read, it can be one of the leaders of risk on or risk off in the market. To what extent are each of your thoughts of this component in the market? So I have a saying about this, but I'll let you refer to this first.
Oh, I think there's some truth to that. And high yield bonds should trade in concert with equities. And because the way I think of high yield bonds is that their equity is in drag. So that if, let's say, and the way I explain it to my students, if you have two identical firms, one's 90% equity and 10% debt, that's going to be an investment grade company, probably a AA rating. Take the same company and make it 90% debt and 80% and 10% equity. That's going to make it a high yield bond with a high probability of defaulting, because the company value of the company's assets only need to fall by 10% before the asset values are now less than the value of the debt. So that's a trigger point and can result in a default. So high yield debt, these are companies that have more leverage on their balance sheet. And so when the equity prices fall, you're getting closer and closer to that point where the value of the equity, or the value of the firm's equity, is going to zero, or another way to say that is the value of the company's debt is approaching the value of the company's assets. And when they cross over, then that's when companies often end up in bankruptcy court. And I'm talking about this on a market value basis, not a book value basis. And then the second thing that moves around is volatility. Has an effect on that. As volatility goes up, the probability of you having the value of your assets get crushed in a substantial amount goes up too. So there's two correlations there. High yield bonds will be correlated to equity volatility, and it's correlated to the level of the market. So as equities go higher, risk in high yield bonds go down, and their price should go up as well.
I think the long-term assumption for recovery used to be about 40%. Is that still a valid assumption?
The recovery, as I recall from the default tables, if we're talking about non-secured publicly traded debt, it's about 60%. Mm-hmm. And then subordinated debt, it's like 30%, 40%, something like that. And that matters. And then if you're secured debt, you're a little bit higher. Maybe you're 30%, something like that. Who would be secured debt? Those are companies like utilities that have power lines and power plants to use as collateral against their debt. So, but most companies, most bonds that trade in the public market are unsecured debts, and they sit below bank debt. Bank debt tends to be is senior. It's always senior if your bank risk manager knows what he's doing, and secured. I remember when I was at ANZ Bank, my group never made a loan that wasn't secured.
So I mean, there is it's less. it's less of a driver for high yield than it's going to be for something like TLT. Yeah. TLT being the most sensitive to rate changes, but there is a rate component. There's a lot less duration typically in something like HYG, but there is some, and so we kind of have to think about that as well. Although there's interplay here too, which is to say that all else equal, if rates are going higher, we would also say that would impact the companies in the high yield space quite negatively. We don't want to see their capital costs rising. It does increase the risk of default liquidity problems. Actually, that's kind of what happened with First Brands, right? So, First Brands was in the process. They just filed for bankruptcy recently. That was the owner of Fram oil filters and Autolite and all that other kind of stuff, the Cleveland-based company. And they now apparently they had debt all over the place, and in many cases they had actually, it seems, used the same collateral twice.
Sneaky guys.
Yes, they were so they were factoring the same receivables with two different
Well, this is sort of the problem that with private equity is they often in my mind, use too much debt. Mm-hmm. And that does two things. It creates inflexibility in managing the business, and it makes life unhappy for the employees that remain after a company gets taken over by private equity. Because what they typically do, load it up with debt, and then they say, well, we got to service our debt, so we got to let go of a third of the staff, and you guys that are left over, well, I know you guys were working hard before. Well, now you're really going to have to, You're going
to do 50% more work.
Yeah, you're going to have to turn up the salsa here, turn up the heat on the salsa. And so I'm not.
What do you think of this chart?
What do we have here? Because it's
this is HYG.
Yes, HYG. You can see it's starting to come off a little bit. Oh, by the way, I do want to comment on your thing about sensitivity to interest rates, and your comparison to TLT. Now, TLT is treasuries that have maturities longer than 20 years. Most high yield debt is something about 5 years, and certainly less than 10. It's very rare that high yield companies are able to issue debt longer than 10 years. That's just an aside. So, and I would say probably the sweet spot is 5 or 7 years. So that's not a whole lot of interest rate sensitivity. They're going to have a duration of about, let's say, 4. So if rates go up by 1%, their price will go down by 4%. So it's not tremendously sensitive. Whereas TLT would probably fall by, because it's going to have a duration of about 25. A 1% move would cause a 25% drop in long-term bonds.
Yeah, and then you have LQD, which resides closer to HYG, but it's probably double the duration. So LQD is the investment grade. Yeah. So the investment grade complex.
They can issue longer.
Yeah, it's interesting. When I thought rates were going to roll over, I had an idea. It proved not to be a spectacular idea. I was, you know what they say, you can be too clever by half. Yeah. So I happened to be looking at the time at the construction of LQD, the ETF, which is the investment grade bond ETF. And I observed that about half, or maybe more than half, of the constituents of LQD's portfolio was the lowest grade of investment grade credit, right? So my thinking was, well, a lot of these are heavily indebted companies. They're the lowest eligible credit grade, which makes sense from the manager's point of view, right? They're trying to maximize yield. They have certain guardrails in place, but they're going to, if you in a very low environment, you encourage managers to take on more risk. So in that environment, it would actually make sense in a super low rate environment like we had, ZIRP, that LQD would be this low grade. So my thinking was, rates are inevitably going to go higher. There's more duration in LQD than HYG. And a lot of that lowest tier might be pressured by rising rates, and some of those companies are likely to fall out of that investment grade and therefore no longer be eligible. Then you could have... So I actually was thinking this could create kind of a run on the worst forms of investment grade debt, and it has more duration. So I was like, that's the thing you should short. But no, you just short TLT was the answer, because it didn't cost you anything to short TLT because the rates were zero and it had all of this duration, and you weren't trying to be like, they're going to have to sell half their holdings.
Right.
I was not right about that. I mean, LQD did fall, but it did not fall as hard as TLT did.
Yeah. So I wanted to talk.
It was a good short, but it was not a great one. TLT was a great one.
Yeah, no, I agree with you. Let's go on to the next chart, because we'll talk about let's start thinking about what could happen next. So now this is the 4-year cycle that everybody talks about, and it's driven by, or at least people believe it's driven by, the halving schedule, that every 4 years the amount of Bitcoin that gets the network reward gets cut in half every 4 years. And now we're down to 3.25, I think it is, Bitcoin per coin. And when there's less coins coming out, it's like, okay, there's greater adoption, so a little bit more demand, because as more people learn about it, at the same time the new supply is going down. So you see these run-ups, and then it kind of hits a peak. Now, the interesting thing that's going on here is that each one of these peaks, run-ups, if you will, are smaller than the preceding one in percentage terms. And so a lot of people were thinking this last run has been so weak that maybe it should extend. And there's been a debate, online about whether or not it's over now. And so we should just get used to the fact that for the next 18 months, Bitcoin's going to, or maybe longer, but is going to work its way to lower prices. The question I have is, if that is indeed the case, if it's becoming less volatile on the upside, is it also becoming less volatile on the downside? A question I do not know the answer to, but it's one that I ask. And then the other is this indeed the case? This is only a few data points. So does this really prove anything? I don't know. There's a story that goes along what we see, right? This halving cycle, a fundamental thing. I don't know. So that's sort of like the bears. This is the chart that have the bears concerned. And then on the next chart I want to show, this is one that a fellow by the name of Raoul Pal writes about in his musings. He's a guy that used to work at Goldman Sachs, and then he was a macro hedge fund guy. And he's a very educational guy to listen to. He's one of the people I listen to in podcasts as I drive to work.
How do you spell his last name? Raoul what?
It's let me just double Raoul.
Yeah, Pal.
Pal. And he's he's kind of an entertaining guy, because not only does he teach you something about macro, which is not my strong point, and the liquidity cycle.
He has a YouTube channel himself called The Journeyman.
The Journeyman, yeah.
Yeah.
And he often, it's like once a week, he does his show by drinking wine and not only critiquing his wine. What happened?
Hi everyone, welcome to it.
Sorry. I searched for it and I accidentally clicked on it, and I was just wondering where that noise was coming from. I realized it was coming from his side.
Yeah. Okay. So he often likes to critique wine and other things. So as he does his podcast, he might be enjoying a glass of wine. So he's rather entertaining fellow. And so he's got this thing about the banana zone, that whatever happens on each one of these things is that on every cycle, it ends with like a buying panic. And so he's been saying that since we haven't had the buying panic yet, what he likes to call the banana zone, hasn't manifested yet. And so we should hold on and not be afraid. So the previous chart, we had a bear case, right? This one, we have a bull case.
That looks like a wild bull case.
Yes. So this is something he talks about. And then the next chart he talks about as well, that he what he did is he took Bitcoin and took the trend out of it, and then he showed that it goes up and down with the ISM, which suggests that, well, maybe that 4-year cycle is by accident, and really what it's doing is that Bitcoin is just in sync with the liquidity cycle in the economy. And so he's laid out these two charts, which I thought is very interesting because I've never thought about this relationship. So it's something to think about. So if we are going to see the next liquidity cycle, which we might, because remember the Fed just said we're stopping quantitative tightening in December, right? And if we continue to have repo problems, we might start to see the Fed pump more money again, in which case the pink line there, the jagged pink line, will start move higher, and it'll drag Bitcoin up with us.
Yeah, I mean, it's definitely interesting, and it's certainly worthy of consideration. One of the things that we can always find pictures that are interesting, particularly if you're dealing with events that haven't. There's not a whole lot of events to deal with, right? It's one of those things that always drive me crazy. I'll hear this is how markets do during presidential elections. And, one of the things I would say about that is, well, that's interesting and all, but in the grand scheme of things, we actually haven't had that many presidential elections. We're only, we're not at a point where we can attribute a massive amount of statistical significance to samples.
Yeah, they're too small.
Where you have events that are in alignment, but those events have not happened that often. Yeah. So you can have interesting correlations. Is there any causality? Although I will say that as I look at this chart, I'm kind of curious about how, about the timing, but there does appear to be a relationship here.
Yeah.
So it's definitely worth exploring. You show me a picture like that, I'm like, okay.
Yeah.
Interesting. I'll have a look. That banana chart.
That is like, okay, that's.
I don't know.
That's going to the moon, right? So,
that's consistent with the $1 million price target, right?
Which so many people want to say is coming. And then there's the last chart that I like to talk about, because this goes back to
what about?
Oh, I'm sorry. Then I don't know if you can put the chart up, Jay. I obviously gave you the wrong thing.
Which chart were you looking for?
Yeah, I dragged in the wrong thing from my desktop. I don't know if you can do this on the fly or not, but it's just a cycle of investor psychology.
Investor psychology.
See, that's we talk about in academia the efficient market hypothesis that we are all rational people. We prefer higher returns to lower returns. We prefer lower to risk than higher than risk. We are rational about the.
Is this the chart that you were looking at? Okay.
And the whole idea of the efficient market hypothesis is we all have these models to use. We all use them. We all make rational decisions. And therefore, the prices we see in the marketplace are fair all the time. And that you might, and they're kind of reflecting the risks in the market and stuff like that. Then there's this idea that people are very emotional. This is behavioral finance. And they do things based on an emotional component. Like there's no emotional component in the efficient market hypothesis. We're all, we're like computers. We do some calculations and we act accordingly. So here's what a typical cycle of a stock looks like, that things start out when stock's at the bottom and this everybody hates the stock and stuff like that. And then it starts to rise up and people they start to see what's going on. There's a little hope that maybe the company is going to do okay. And, before you know it, the stock's still going up and there's some optimism there. And then now people really buy into it with a belief, and if they've bought the stock, they feel a lot of thrill and euphoria here at the top, which could have been, 6 weeks ago in Bitcoin. It's like when we hit the top, I think it was around 125 grand. But ever since then, it's been falling, and everybody's been saying on financial media and so forth that, oh, this is just a little correction, just a wiggle in the upward move of the share price, and so we get that complacency that's going on. But we're starting to see some anxiety. I didn't put up the fear greed index, but the fear greed index is like around 15 or something right now.
Yeah, it has gone up, indeed. Yeah.
So people are very, very scared. But I'm just wondering now, when I put up these charts from Raoul, and I kind of think of this as a little bit of the Tom Lee effect, because the complacency that he says, don't worry, Ethereum's going to 8 grand and Bitcoin's going to 180 by the end of the year, that helps people get complacent about what's going on. Maybe they remain over levered. Maybe they don't take some chips off the table when it's way up high, stuff like that. Now, I'm not picking on Tom because I think Tom's great, and I think he does great work. But he's moved into guru status. He's on TV all the time. Some places on a podcast all the time, and a lot of people pay attention to him, and I think that has an effect. And so I just wonder if he's going to be right and everything is cool and we bounce off that trend line, or are we sitting here in denial and with the next leg to fall out? So if you think the 4-year cycle is over, we're in denial and we're going to panic and to capitulation. But if we're in the Raoul camp, then we're about to go into the banana zone and make a fortune. So this is a kind of a crazy time to try to figure out what's going on, because if those two things are really the two outcomes, we're going to have either something spectacularly up or spectacularly down. I don't know either or which.
Put differently, we're not just going to chug out of this at a slow and steady pace.
Yeah, it just seems like
your take is that we're at a juncture where we are likely to experience something fairly profound in a short period of time, but the question is unresolved as to what that's going to be. I mean, I would make the following point, which is that we like to see traders, pundits, whomever, we very much like to see those Mark Haynes moments. Where it's very clear. It's so obvious. So Mark Haynes, for those who don't know, longtime anchor on CNBC, tragically passed away a couple of years ago. And he basically called the bottom in the GFC.
On the day.
On the day, yeah. He watched the market washing out, and he said, I can't remember what his exact words were, but it was something like, I think that's it. I think that marks the bottom. I will also say that in a broader sense, there was another CNBC host who was on all the time back then, and I was on his show, and that was Larry Kudlow. Larry Kudlow also called it.
Mm-hmm.
Now, Larry is as much a political commentator as he is an economic commentator, as he is a market commentator. More so, actually, I would argue, than he is a market commentator, although obviously he looks at it. But I remember him saying to me, Mike, are we now at the beginning of a new secular bull market? Somebody can probably find it. And he was saying it sort of, very definitively. Aren't we now at the beginning of it? He was really trying to get me to go along with it. Now, as an options trader, we tend to be a little bit more hedged, right? Yeah. We're always a little waffly, whatever. But he really did see it. Mark Haynes really did see it. And, one of the things is that when you get that kind of washout, you see valuations get to a level where you can now say, you know what, at these prices, the chances that the market is materially higher in 3 years, 5 years, and 10 years gets very good indeed.
Yeah.
There was that earlier regression, that scatter chart that we showed, that if you're buying against a historically cheap trailing multiple in the S&P,
yeah.
your returns over time tend to be much higher. And that's not to say that you're not going to suffer some short-term pain. You can. But in the long run, you're in very good shape.
Yeah.
The valuation where we find ourselves, I think this is part of the problem, is that when I look at the valuation, I say, well, we have not had the panic. I can definitively say that, because valuations are still above average, not below. Panic is usually accompanied by multiples that are considerably below the long-term average, and we have not seen that. They're accompanied by breathtaking gaps and big volume. And we have not seen that confluence of events. Doesn't mean we're going to get it today. This is, as you pointed out, seasonally, we get Christmas rallies, typically. Back half of the year is generally pretty good. Carter Worth, it should be said, made the point that you don't typically get really big downdrafts in close proximity to one another, because the first one tends to wash out a lot of weak hands. And we had one in April. So, is it common within the same year, unless you were in, say, a huge bear market, to have these kinds of big downdrafts?
No.
And we had a downdraft going into late 2008. Market recovered somewhat, and then it rolled over again and hit ultimately its lows in, was it March 2009? I think it was late March 2009, if memory serves. But, we haven't had anything like that yet, either of those two events. My inclination is that we're not going to wash out before the end of the year. I realize that in general, the 30-day returns for the S&P tend to be pretty good when there's a lot more fear in the market. And this is not a panic. We haven't had that. But there is more fear. This is typically a better time to buy than sell.
Yeah.
And we haven't also, in conjunction with this, we haven't had that disastrous news that frequently accompanied some of those other events. A Lehman Brothers failure. And that, by the way, was precipitated by a couple others, like Bear Stearns and so on. We haven't had that. So I think we'd kind of, in order to fall to below the box you've written here, I'm going to leave Bitcoin out of this for a second, but just for equities.
For equities, yeah.
Yeah, for equities, for us to fall below that box, we would need some kind of meaningful news, a catalyst. That's my take. I think we need to see something really disappointing. What could something like that be? Well, we've got NVIDIA earnings. Those are still ahead of us.
Yeah.
And if those turned out to be somehow, disastrous, I don't see that happening. But, that's... It's hard to say that wouldn't have a profound impact. But I don't really see that happening.
Yeah. The only thing I could see is somehow they guide down, but the chairman has been running around saying that, they sell as many chips as Taiwan Semi can make for them. So I don't see them guiding down in their next earnings report. And I think they're going to be up substantially in terms of both revenue, cash, and profits.
Doesn't the lower price, though, for isn't there a little bit of a self-fulfilling thing here, just to play devil's advocate, that other users of NVIDIA GPUs include the miners? Now, I'm not so much
anymore. That was kind of true.
But
4 or 5 years
ago.
ago.
It's on the edges, like it's an incremental, a marginal demand.
Yeah, it's a very marginal demand. I would say it's not there because ASICs chips, those are chips that are designed to do nothing but mine a particular coin. If they don't do that, they don't have any use. They're called application-specific integrated circuits, ASICs. And
is that what's in your machines?
Yeah, that's what we run here at the school. Those are ASICS machines. And then we do have one GPU miner because we got a firm to donate a busted up 6 GPU miner. So it's like one motherboard and 6 GPUs connect to it. And we ran it for a while and got some ETH out of it. It quit, and we're in the process of repairing it now, and we'll start mining maybe some Zcash or something like that, which is a privacy coin that has taken off in the last 2 or 3 weeks. Went from like
really?
$50 to $800 or $900. So
what?
Yeah, so it's
now you tell me.
Yeah, now you tell me. It's like the big rally. Yeah, and it kind of came out of nowhere while everything else is crapping out. But that's the
that's why we do these things, like to give people insights, like give me insights like that. Zcash.
ZEC is the ticker on something like CoinMarketCap.
Oh my God! Look at this thing. Come on now.
Yeah, it went from sleep to.
I never even heard of it.
It ripped. What's the high number? I can't read your screen.
The high was 736.
Yeah, not a bad day.
So
not a bad day's work.
This was $34 and change in late August.
Yeah. So these are private.
So, I mean, I appreciate you bringing this to my attention, and I don't appreciate it.
You'd like it if I told you a few months ago. But I always thought privacy coin. There was a place for privacy coins because I always thought places like Venezuela, Cuba, to the extent that people have a computer in North Korea and can connect to the World Wide Web, any of these sort of harsh regimes, people might want to transact with a privacy coin that it's either impossible or difficult for the government to know what they're doing. So I always thought that these things. I'm sorry, I didn't hear that question. Oh, look at call up Dash DASH on their mic, and then Monero. Yeah, Monero's
DASH.
Yeah.
Dash. What's it? Dash what? What's their? Because it's obviously not DoorDash, so it's.
That's the name of it. Let's see
Dash.
here. Let me go look and see if there's a place.
Give me a ticker.
Where we could do this. CoinMarketCap.
Here, give me the other one first.
Monero.
What was the other one?
XMR, I think it is. Is that what it is?
Monero. Yeah, that's right.
That one did well. I'm not sure it did as well.
No, it did not, but it certainly has done well. I mean, it was up 80%. It's up considerably also, again, since mid-August.
Yeah.
What is very interesting to me is just taking a look at some of these as a pair against Bitcoin. Bitcoin obviously has done very poorly in this region, so basically topped out over here, rolled over.
A little bit of rotation.
You know what? Can you do me a favor? Publish if we don't have a list of these things on the Options Edge website, can we put them up there just so I can just refer back to it? I think these other ones to look at.
Yeah. I used to post a page with these prices.
Well, I don't need the prices, but I think that some of these things are they're news to me. They may be news to some of the other people watching. I had not been looking. I mean,
we could do it. We could do an occasional discussion
think people
of
might find that interesting.
What's happening in the what they call altcoins. I hate most of the altcoins because they're more like pump and dumps, and I think there's more than 1 million tokens out there now, whereas CoinMarketCap lists like 20,000. I think they kind of capped themselves out at like 20,000 coin.
All right.
Okay.
Okay. There it is. Okay, so
Monero, by the way, was John McAfee's favorite coin.
Oh. interesting guy, and not in that was both a good thing and a bad thing.
Yeah.
So that's
yeah. So it had a little go, and it looks like it wants to go to a new high after sort of a super peak there.
All right.
An exciting place to be.
I would agree. Well, this is interesting. I mean, first of all, I think that your points about investor psychology are well taken, because there have been plenty of flaws. I actually got Truth Social on my phone because it was fairly clear that you have to pay attention to the president's posts, because they do have market implications. So I do. That's the only thing I basically follow on it, is just wait for a little chime to see whether, he's pounding the table saying buy stocks or sell stocks, or, we're going to do this or that, and the market, moves by 1% this way or that when he does those things. But actually, the post that I just saw actually only comes with the fact that he's welcoming MBS, Saudi Crown Prince Mohammed bin Salman, which is quite remarkable when we think about that guy's history, and some of the things that he's done in the past that are pretty horrifying. But it is what it is. We're not going to get into that gruesomeness. For anybody who doesn't know, they can look into that. But there was a journalist who worked for the Washington Post who went in, I think, to get his visa renewed into the
they declined
the Saudi
renewal.
consulate. It was revoked, along with quite gruesomely.
Yeah.
Anyway, well, this is very interesting as always. Appreciate it, your time and attention. For those watching,
nice.
Please like, subscribe, add your comments and questions, and join us this time next week when we do another one of these. One quick point, and that is, I don't know whether we intend to do any office hours the week of Thanksgiving. I assume you probably have a full schedule. Do you have that whole week off?
Well,
or what?
Next week I can't sit in because we have Thursday, Friday off, and they take my Thursday classes and move them to Tuesday, and I teach 6 hours on Tuesday. So my whole day is taken. So I can't do one on Tuesday of next week. The week after that I can, but
okay. So let's just take a look at the calendar. So we will, so we won't be doing an office hours next week. We will be doing open mic as we usually do, 4:15 on Monday and Wednesday. Maybe you can join for one of the open mic things. We'll do that instead. We'll do a combo if you have availability. Okay. That could be good. All right, everybody. Well, as always, like, subscribe, comments. Tune in for our next open mic, which is going to be taking place tomorrow, 4:15 Eastern Time. And until then, thanks for watching.
Good. Well, I can probably do that